Good morning and welcome to this webinar. My name is Bernhard Bartsch. I'm the incoming Director for External Relations at the Mercator Institute for China Studies, and I have the pleasure of steering you through this 1-hour presentation and discussion of a new study by two super cool colleagues whom you of course all know, Janka Oertel and Agatha Kratz. Both of them have, over the past years, been really instrumental in shaping our understanding of China and what the so-called China challenge means for Europe and what areas policymakers and companies need to look at. Janka, who is the director of the Asia team at ECFR, and her team have, for example, worked a lot over the last years on 5G or climate change and the implications for European policy. Agatha Kratz, who is the associate director in Paris for Rhodium Group, has worked, for example, a lot on our understanding of Chinese investment or critical infrastructure. And now they have teamed up to do a study that has just been launched this morning on what they call the protected home market advantage that China has and the implications for European business and economic policy. Protected home market advantage is the new term that we're going to learn today, and I predict that after this 1 hour, you'll be fluent in saying that and taking it up in your active vocabulary. And I guess a lot of you will decide to actually do so because it's a really important facet of how to look at China and its global influence. And the way we'll go about this is that Janka is going to give us a short framing of the concept, then Agatha is going to go more deeply into the study, and then we'll have a lot of time for questions from all of you. Please use the question and answer function, and I'll then read out questions from there. And I hope we'll have a very good discussion. And with that, I'm turning it over to Janka to kick us off. Janka.
Thank you very much, Bernhard, and thank you for the very kind introduction of this Franco-German endeavor that we have started. It's a great collaboration between ECFR and Rhodium Group, and we're very delighted to be able to present this report today that we've been working on over the last couple of months. This was prompted because times have changed. The recent sanctions row that we have witnessed between the EU and China and the controversies around the Comprehensive Agreement on Investment have demonstrated that the Chinese leadership is not only much more confident in its dealings with Europe, but it's also kind of changing its priorities. Good relations with Europe are not necessarily a top priority anymore for a China that is oozing confidence and centralized power. The investment agreement in this case could become an acceptable collateral damage to the Communist parties lashing out against any form of criticism from the outside. In this kind of context, the Chinese leadership is set on detaching rather than further integrating China from international supply chains and even the international financial system. It is no longer about reform and opening up, as it was the Deng Xiaoping kind of motto, but about partial reform, selective opening up, a lot of closing off and strengthening from the inside. China is turning towards greater self-reliance, and this is indeed something to worry about just because of the scale that we are dealing with. This trend has been present for a while, but it has certainly been accelerated over the course of the past few years, and particularly in response to the increasing rivalry with the United States and the kind of the deliberate reinsertion of risk into the market in the relationship between the US and China, and in kind of relationship to that also with European players and others, obviously. The Chinese leadership has a different version of globalization in mind while it's doing that, one with China very much at the center, and one where the role of the Chinese market becomes ever more important, where the internal circulation of the much discussed dual circulation strategy of Xi Jinping is of enormous relevance as it insulates China from some of the inherent problems and potential disruptions of a globalized economy, weaponized interdependence, and political instability. It is, as such, a political and not necessarily an economic strategy. And I think that's really important to keep in mind. So if we follow this logic, China's vast but protected home market becomes a huge asset for the development of its industrial base within China, but it also allows to create international economic players that are sort of on steroids, that are beefed up in their presence through the kind of home market advantage that they have. And they will be able to severely challenge competition from Europe or elsewhere outside of China. In a nutshell, what we call the protected home market advantage is an opportunity for Chinese firms to leverage the vast size of China's market to build scale, amass profit, and improve productivity, technical capabilities, product design, and quality, all with limited or no pressure from foreign competition. And this then enables some of them to enter foreign markets on a strong financial footing and to sell tried and tested, more tailored products at highly competitive or below market prices. Now, this may sound a bit self-evident, but the consequences are far from trivial and until now a bit unnoticed, or at least not discussed enough in European policy circles. There is a greater focus on subsidies and other support Chinese companies receive than on the enormous closed market as such, which can have an even greater distorting effect in some of the sectors that we looked at. Policymakers in Europe are very well aware of the current challenges in dealing with China and are looking into mechanisms to defend against the growing economic might, from foreign direct investment screening to the international procurement instrument to tackling foreign subsidies. But there's still sort of this logic behind it, which was very present in the Comprehensive Agreement on Investment negotiations, that a priority should be set on opening the Chinese market for European business. And a lot of political energy was spent on the latter and much less on the other tools. While the intellectual thinking on the other tools is there, the political pressure to really move them forward is still lacking. The underlying principle that a more open Chinese market would level the playing field to a greater extent is not wrong, but it's a necessary and not a sufficient condition for actually a fair trading relationship. If parts of the market remain strategically closed formally or informally, as we show in our report, the effects can be enormous and challenge the competitiveness and even the existence of entire industries in Europe. What we have tried here, and kind of the godmother of this project is obviously Agatha, who's also the economist behind it and the brain behind this. So that's why I'm also just allowed to give you the framing here. We have attempted to do with this report is not to lay out like the top 3 ways to eliminate the protected home market advantage in China. That's impossible in the near future, and it's not what we attempt. What we rather want to do is raise awareness about the existence of the phenomenon more clearly and why it is so distinct and consequential in the Chinese case, to incorporate this into the development of future economic and industrial strategy and in the new policy tools that we are developing. And I think it would be now a good time for Agatha to tell you more precisely what we have been doing in our case study. So Agatha, over to Paris.
Thanks so much, Janka. And to start us off, I would ask Manisha to share the slides that we've got, if possible, for everyone to see. You've done a great job at introducing the concept of a protected home market advantage. And I'm going to spend a little bit more time explaining what it is, mostly because I think a lot of the policy thinking around the challenges coming from China's alternative economic model has focused a lot on state support, has focused a lot on subsidies, has focused a lot about on subsidized input and preferential inputs. But at the end of the day, the protected home market advantage that we're going to describe in a minute is actually, or can actually be, much more important, consequential, detrimental to certain industries. And here, I think one of the things that started our study, started our thinking, was a study by MIT researchers on the solar industry, where they studied what allowed Chinese solar PV module manufacturers to decrease prices so sharply around the 2000s, end of the 2000s, early 2010. And a lot of people, in the public debate would think subsidies, state support, low-priced input, but actually what they found was that it was merely and mostly to do with economies of scales. Those companies were producing so much on such a huge market that this was the single biggest reason why they could actually undercut their competitors. And so at the end of the day, it's almost as important to understand the protected home market advantage as it is to understand state support, because in the solar sector, at least, take away all of subsidies, take away all of the state support, and there would still have been a huge impact and huge consequences for the European solar industry. So that's why it's so important to speak about it. It's a really little known concept. Not a lot of attention has gotten into it, but it deserves much more. And this is what we're trying to do with this report. So if we go to the next slide, I'm just going to spend a little bit more time explaining what we're speaking about, because it's a new concept. And it's also a term we've pretty much kind of defined ourselves to try and explain one of the realities on the Chinese market at the moment. So a protected home market advantage is a competitive advantage that will arise where certain firms in certain sectors, not all sectors, not all firms, but certain firms in certain sectors, will have access to a vast yet protected home market, which will give them a competitive advantage. If I say that differently, in a number of sectors in China, again, not all, the combination, and you need both, the combination of a huge Chinese market and at the same time, high formal or informal barriers to foreign competition will create a huge competitive advantage for Chinese firms in ways that are actually very similar to subsidies or state support, but just the mechanisms are not the same. And if we start with the vastness aspect of it, I think it's worth saying again that China's market today is in fact, the world's largest for a very, very wide series of goods and services. Think about automobile, think about construction equipment, think about beer, think about mobile payment. Over half of the world's 5G base stations are actually located in China. A third of global solar capacity is installed in China. And that's compared to, the Chinese economy making up about 15% of global GDP. So much, much, much bigger than the GDP weight should tell you. Now, I want to say it very clearly, the size of China's economy is not in itself an issue. It's not size alone that is an issue. And China's size, comes naturally from a massive population, a wide territory, fast-paced Chinese growth, and the huge modernization we've seen in China's economy the past 15, 20, 30 years of its fast-paced growth. And because it needed, especially to equip this fast expanding economy, China has deployed enormous resources building transport, communication, and other infrastructures and networks throughout the country. And that's created enormous demand for certain goods and services in China, which is explaining some of the numbers I've just mentioned. One really telling example is that of rail. Within the last 12 years, China decided that they wanted to modernize its transport network, and it decided it wanted to link all of its multi-million cities, over 150 of them, by linking them with high-speed rail. And 12 years ago, 2008, there was 0 kilometer of high-speed rail in China. But today, China has more high-speed rail lines than all of the other countries in all of the world combined. And 60%, more than 60% of all high-speed rail trains today run on Chinese rails. That means that the demand over the past 10 years and still today for those kinds of goods and services in China is enormous, and it makes it one of the biggest markets for those goods. Now, that's on the size part of things. And once again, size in and of itself is not an issue. On the contrary, where this size advantage is shared, where barriers to entry are low, where foreign firms are welcome, it is actually a huge boon, and it's a huge boost for European firms. We've seen them, and we've seen our companies benefit tremendously in automobile, consumer goods, electronics, but they've actually captured a very, very big market shares in China and made revenues and profits over the years, and actually just become much bigger and stronger for that matter. Now, where the problem arises is that second part of the equation. That's when barriers to entry are high, whether they're formal or informal, and where Chinese firms end up kind of artificially, so to say, dominating that vast market. Then the situation is really different. And in that situation, because they can leverage that size, they can leverage that closeness, Chinese firms will be able to build a huge competitive advantage against their foreign competitors. If we go to the next slide, let's go just very quickly about on what the mechanisms of that advantage actually are. And those advantages depend on the sector you speak about. And if you go, and I would encourage you, of course, to read the full report, but depending on the sectors, different mechanisms might be at play. But most of the time, it will revolve around 6 main advantages from scale and closedness, so the combination. The first advantage is very mathematical. If Chinese firms have access to the Chinese market on a somewhat artificial basis, preferential basis, that will just mean that they will get more revenues than they would in open market competitions if there were competitors on their market, foreign competitors on their market, which is in and of itself already an advantage. Now, if those firms are well run and if they're efficient enough, higher revenues will also translate into higher profits and an ability to generate more profit than foreign firms and foreign peers. And profit is really important because it can be reinvested in two things. It can be reinvested in R&D. And as a matter of fact, if you look at our case studies in the report, we show that not only does, for example, Huawei in the telecommunication sector spend 50% more on R&D for specifically 5G technologies and equipment than Nokia or Ericsson, but if you take it at the absolute value, it is every single year $10 billion more in R&D. So bigger revenues create bigger profit that can be reinvested in R&D to create more innovative products. In addition, bigger profit will allow you to kind of cushion and favor and ease international market penetration by proposing lower prices because you know you have a cushion of profits at home, more flexible packages, a more tailored offering for your clients, and that will make you more competitive. So very, very important on the profit side of things. Now, something that people think about less is also the credibility that being the biggest player on the biggest market on earth gives you. Because if you're CRC, the biggest rail player in China, and you've built or you've equipped, 30,000 kilometers of high-speed rail, then clients throughout the world, in Europe, in the US, everywhere, will trust you to be able to deliver those products at the highest quality and with no technical problems because you've produced so much of it. So the credibility that goes with it is enormous. And that credibility is also true when your profits at home make you stronger financially, because in a number of sectors that are prone to a protected home market advantage, and we'll get to which those are, but a lot of them are procurement sectors, equipment sectors, infrastructure sectors, then clients are countries' tendering authorities, and they really do not want to mess it up. They want to be able to say that contract that I gave to someone for 5-10 years, that company is still going to be standing in 5-10 years. They're not going to run into trouble. They're not going to default. And so that gives credibility also to Chinese players that they're so strong, they're not going to go bust, probably, or most likely. Now, finally, and this is really important, the size you build on China's vast yet protected home market in certain sectors will allow you to lower production costs and therefore potentially lower sales costs. How? Through internal economies of scale. The bigger you are, the more you can automate your production, you can use your machines more, you can reduce wastage, you can demand higher prices from your clients, you can demand lower prices from your suppliers. All that together allows you to lower production costs. And then external economies of scale are a little bit more of a complex economic concept, but in short, those companies will have access to China's extremely dense industrial clusters, which by pulling together specialized suppliers, specialized labor, specialized demand, will decrease the cost of doing business. And that's actually really important for some of the industries we cover, especially solar and to a lesser extent, telecommunication. So in short, if you combine all of this, all of those elements, not all will be present in all industries, but if you combine those elements, now you add to that other elements of the Chinese model, state support in certain industries, lower capital in certain industries, you create a situation where Chinese firms in certain sectors are able to offer cheaper products, more innovative products, more custom or flexible offerings to some of their clients. And we actually show in the report that, and we looked into contracts of China's rail and telecommunication players. Those companies, when they go abroad, are able to propose prices 10 to 30% lower than the second best bidder. That's not the general price, the second best bidder. And so it creates a pretty incredible price advantage, also a quality advantage thanks to R&D spending. And it allows them to capture market shares, greater market shares. So that's really important. And we've shown that, if we can go to the next slide, we've kind of illustrated that in a series of three industries. We speak about rail rolling stock, we speak about solar PV, And we speak about telecommunication equipment, and we try and show not only the mechanisms of how that happens, but we also show what the effects are potentially on European market, global markets. As I just said, and if you look on the right-hand side of this slide, you'll see that the prices that CRRC, China's biggest rail company, rail rolling stock companies, the prices it's able to propose on global market are significantly lower than what other players might be able to propose. Siemens, Alstom, Bombardier, those companies just don't stand a chance for some of those contracts. And then the second effect, if you have lower prices yet excellent products, is that you're going to lose, or you might lose, some of your market shares. And this is what you see on the left-hand side of the slide, which is Chinese solar PV manufacturers, module manufacturers, just gaining incredible amount of market size over the past 10 years, going from below 50% of the global market to now over 70% of the global production market for solar PVs. And that has an effect on our own industries. The two lines on the bottom, yellow and blue, are US and German producers. And that's what can happen for European industries. That's the effect. Now, before we dive into the Q&A discussion, and if you don't mind going to the last slide, this will be my last comments. I do want to note a few important caveats about the protected home market advantage and leave you with a few big ideas about it before we get to the discussion about what we can do and other questions. The first caveat, and this is what this slide is about, the first caveat is that not all sectors will see a protected home market advantage. As I mentioned, many sectors in China are actually pretty open to competition. Think about luxury goods, think about consumer brands. There's actually a lot of space in a number of sectors and in many sectors in China for foreign competition. So we're only looking and we're only speaking about a certain subset of industries. One of the bubbles you see on this graph, a certain subset of industries where there are high formal, informal barriers to competition in China. And of course, not all sectors either will reap advantages from scale. We're putting it here on the slide by saying, you know, some sectors are more or less prone to economies of scale. And this is where you see in the middle what is actually the sectors that are most likely to see protected home market advantage. But it's really important to know that some industries, the larger they grow, not necessarily the lower their cost. So not to be overestimating the presence of that advantage. Second caveat, the combination of vast and protected, even in industry that have high propensity to economies of scale, does not always lead to an advantage for Chinese firms. And here on this slide, you see automobile manufacturing as the first category. And actually in automotive, European firms, despite all of those factors, have been able to retain a unique advantage on their Chinese peers. So really important to say, even if you've got those two factors, it might not be that Chinese firms manage to have that advantage. In others, they might, and in others, they do, but important caveat. Third, not all of these advantages are unfair. Of course, China can't do much about its size, and that's just here and there to be had. And also, it's not the only country that protects some of its more strategic industries. If you think about missiles, which we have on the graph as well here, all countries or most countries will protect their defense industry, for example. And so there are some places around the world, not just China, where certain sectors, strategic sectors, are protected, and that's how it is. However, and we show that in the report, China is typically more closed off than other OECD countries. And so that's something to keep in mind. Fourth and finally, using a protected home market to conquer foreign markets is not new. We've seen that happen in Japan, we've seen that happen in Germany, we've seen that done with the US as well in their time and historically. Now, the thing is, many of those barriers have been rolled back because of external pressure, but also because in the long run, protecting too much actually stifles company. The problem is with China, waiting out for normalization, waiting out for opening might actually be too dangerous for a number of reasons. The first one is the size of the Chinese market is so big that the competitive advantage is just that much more acute in the case of China. And so the impact on European industries in the short run might be too hard to take. Second, you add to that, and in the case of China, you have such high subsidies and state support in certain sectors that the two factors interact to create yet more of an of an advantage. And that's actually pretty dangerous. In other cases, there were some level of subsidies, but just not to the same tune and not to the same scale. And finally, China in its latest policy announcement doesn't seem to be pointing to more opening. Of course, there have been piecemeal openings in the recent past in financial services, speaking about NEVs, but overall, when you read the directions of the 14th five-year plan, for example, we aren't seeing China moving towards a principled openness stance. On the contrary, you see it moving to more closedness in certain strategic sectors. And it happens that certain of those strategic sectors are prone to a protected home market advantage and are crucial to Europe's own economic well-being. Think about renewables, think about new energy vehicles, think about telecommunication and other critical infrastructures like transport, think about digital. All of those are extremely important for Europe's well-being, yet they also are industries that are prone to economies of scale and facing high barriers to entry in China. So I'm going to stop it here, but just wanted to introduce the concept and explain why it was so important for Europe to wake up to that advantage. Bernard, I believe you are muted, as any seminar should have.
Now you're good.
Thank you very much, Agatha and Janka. We have the first questions coming up, and I really encourage everyone watching to send us your questions. I have plenty of questions of my own, but I'm going to read out your questions first and bundle them. And I'll take the two questions that we have here first before we then go to the onto the whole policy aspect of your paper, because these are two fundamental questions, and you answered part of it already when you talked about your last slide. One question here is whether the protected home market advantage isn't a really old story for Western industrial players like Boeing, Airbus, whether this doesn't really succumb to the winner-takes-all logic, and what really is the difference then between the Chinese market and the US market, or I might add, the European market. We always have this pride in Europe that, at least in terms of GDP, the EU or Europe is the biggest market. So what is the fundamental difference there?
That's a really good question. And of course, that's one that we've asked ourselves throughout the study. I was actually reading a book 2 weeks ago that was speaking about protected home market as an issue in international trade. And the book was from 1990. And every single time I saw Japan on the book, I could have replaced it with China, right? Because back in the days, Japan did pretty much the same. And I think this is something I started saying and started pointing to on my last slide, that it isn't a new strategy. Protecting one's home market or infant industries to make sure that they could develop and then be competitive abroad is something we've seen a lot of. There are a few fundamental differences, though, in the case of China. The first one is that those protections have actually come down slowly out of external pressure, but also out of a realization that it wasn't really working necessarily in the long term for those industries. And so after a number of years, after external pressure, those barriers have actually been lifted to a certain extent and to a great extent. Some sectors remain a bit protected, but it's not worthy that it didn't last nearly as much. In the case of China, we're seeing policy signals that really don't point to that. And we're seeing, despite external pressure, a government that is saying again and again, we need to protect and indigenize our strategic industries. So that's the first very big difference. The second is the number of sectors that are protected in China remain much higher than in all of the other economies. And this is one of the graphs and one of the studies we've got in the report, that China's market is just much more protected than other markets. And so, yes, it's happened in other cases. Yes, in certain industries like Airbus, Boeing, we still have a little bit of that, but we're not speaking about nearly as much of the economy. And so that's why it's worth highlighting. Third, China's market is larger. And so protected home market gives you advantages. You've got more revenues than you would under open economy. You have more profit, you can reinvest them. But the last two lines or the last two factors of benefits from a protected home market advantage are economies of scale. In the case of China, the market is so big that this factor will be crucial and it will allow those companies to just do much more harm. So that's another difference. Last difference is Chinese companies not only benefit from a protected home market, they also benefit from other forms of state support. And so if you combine the two, it also gets you to a much stronger advantage, which is where the problem lies. If you only had one or the other, it would already be problematic, and it would already be WTO problematic for subsidies, of course. But you add the two, and it creates really dangerous situations for our industries. And finally, I want to say it's not because other countries have done it and they've been punished for that. It's not because other countries have done bad things that we should allow China to do it. It is a problem. It was a problem. There was a whole book written in 1990 about why Japan's protection of its industries was a problem. And we're doing the same. It is still a problem today because when other markets are open and when they are competing with players in certain industries that are core to their economic well-being, renewables for the future, Bianca will speak about climate, critical infrastructure of all kinds, etc. There is a real risk, not only for economic competitiveness, but also for just autonomy, resilience. And this is what we're facing at the moment.
And if I can add maybe just briefly, what we are trying to do here is change the narrative in the policy heads a little bit around this. This is not just about demonstrating that this exists. It exists, and that's what I was saying. It's almost trivial to make the point that China is a very big market. You know, I don't think we need to explain that to anyone, but sometimes the consequences do not seem to be so entirely clear. So especially in the 5G debate that we had, I think it was very often the case that when making the point that there is an unfair advantage and there is competition that is taking place in an unlevel playing field, policymakers' response across Europe was often, well, but European companies have not invested enough in R&D. Maybe they're just not competitive enough. Maybe they're just not good enough in that time. Maybe they deserve to be kicked out of the market, so to speak. And I think what the study shows is that it does have, there is a limited degree of choice here when you're competing on such a scale. And I think it's important that policymakers understand this and that this kind of sinks in deeply, that this is not something that individual companies can deal with, but that this is a large scale problem that will only grow bigger the more potent Chinese players become, and that this has an effect on kind of the long-term future. This is not about individual companies. This is not about even individual sectors. This is about entire industries that can, in the longer run, be dominated. And I think the aspect that Agatha was pointing out is like waiting this out until the disadvantages come in. It's just, this could be exactly our problem where we fall, because industry sectors could be dead by that time in Europe, to be just brutally honest and brutally frank here. Some of those industries may just not survive that, even if in the longer run it becomes a disadvantage and competition is stifled and Chinese companies will not be as innovative enough. So I do think that that kind of awareness raising aspect of it, the narrative changing aspect of it is really important around what we're trying to do here.
Excellent, thank you. This answers the other question, which was the first one that came up about the diseconomies of the whole concept. And I guess we don't have to spend too much time on it here. It's obvious that this protected home market advantage that you're talking about plays to, or is the area where China plays its advantages well. And when it does that, it creates problems for us. When the disadvantages kick in, that creates problems for China mostly. But from a European perspective, we are interested in the areas that affect us, and this protected home market advantage is really what we need to look at. Before we come to further questions, which are excellent, and we'll go and look at certain industries, let us go to the policy side of this. You've given us the analytic framework. You're shifting the view a bit of how we look at China, not only as a big market that our companies can send their products to, but actually a country that is becoming competitive itself. What are the policy recommendations that you give in this concept? Maybe Janka, you start this time.
Yes, of course. So we have basically laid out four ways, four approaches that we can tackle, and I will just briefly sketch them out, and then Agatha can add. We obviously say that it continues to be in the European interest to be present in the Chinese market, and I think as a fundamental baseline assumption, trade between Europe and China is in Europe's interest. But we obviously also all know that we need to do this with a much more cautionary attempt now, and the Comprehensive Agreement on Investment has already demonstrated how even if we push for some of these openings, and even if we get an agreement settled, politics is currently getting in the way of a lot of this. So this cannot be our only approach, and this cannot be the only approach where we attempt to kind of level the playing field. The second aspect that we can look at is kind of just protecting and advancing Europe's competitiveness and its market power. We need to be sure that we have our defenses right, and that in all of the instruments that we are now thinking through, from foreign direct investment screening to the foreign subsidies white paper, that we just really have our this home market advantage in the back of our heads. Because as we said in a pre-briefing yesterday, I think this was one of the problem with this is it's a difficult beast because it sits between things where different entities in Europe are responsible for. And that always creates bureaucratic problems. And then the different silos that are DG Trade and DG Competition, whoever's in the member states are dealing with this. So we need to just figure out a way to integrate this better into our policy thinking and just make it an overriding aspect. The third aspect is that we obviously need to also play offense, that we need to create scale elsewhere, that we need to work with partners to offset some of the negative aspects that we have. And that is not something Europe can do alone. This is something that Europe needs to do, definitely in partnership with the United States, but particularly also with its partners in the Indo-Pacific. It's of great relevance. And obviously, there are hesitations to work on joint R&D and to build, to just kind of throw your power together. But all of these barriers and all of these political barriers that exist, or economic uncertainties that exist between the partners even, are smaller probably than the challenge that the players are facing. And I think that's about creating also the political dynamic behind this to really understand the size of the challenge, and then create the coalitions that are actually capable of, out of themselves, without changing China, out of themselves, to actually be better and be more competitive in this. And finally, the biggest tool that the Europeans have at hand is their own huge market. And that's something that has been coming up in all of our discussions with that interviews that we did for around the paper, is that the fact that our market is still prone to barriers with different regulations that make it difficult for companies within Europe, within the single market, to create the same kind of scaling effects here. That's something that we can inherently do by ourselves, where we do not need China for any, we don't need China for that. We can just kind of clear those barriers out of the way, and just by that, become much more competitive in that regard. So these are just the kind of four things that we sketched out, and maybe Agatha, you want to add?
Yeah, just adding a few points on a pretty comprehensive presentation already. But I think one thing to say is we've got a lot of tools that are already relevant. And so it's a matter of using them more. And I will cite three of them. I think the public procurement directives are a tool that we can use much more of. As you saw on the last slide I presented, many of the sectors that will show a protected home market advantage are also sectors that are tendered in both or served through public procurement. And so Europe has within its tool and its public procurement directives the ability to refuse or turn down or at least challenge abnormally low prices, which is what we're seeing when it's minus 30% over the next best bidder. You have an abnormally low price. So that's something you can use. You can also use anti-dumping tools when this happens through trade rather than procurement. And the same mechanism is at play. If you have abnormally low prices, you can just question where those come from and make a case for the fact that those come from advantages that are probably to a certain extent unfair or artificial. And the issue here, of course, is getting industry on board. And that's a problem we've seen in the past and we'll see in the future. But provided that there can be a mechanism that protects them to a certain extent or shelters them to a certain extent, that would be extremely helpful. And then the anti-subsidy instrument, if and when and how it gets implemented, already speaks about the protected market as one of the aggravating factors for subsidies. And I think this is something that should stay into the final text. It will be up for discussion. It's a complicated concept, but it certainly should stay into discussion. 3 more things. The first thing to do is to talk about it and to write reports about it. This is what we're doing here. And I'm saying this, it seems obvious, but remember in 2019 with the communication, the joint communication on China and the strategic outlook, Action Point 8 just said we need to map out what the issues are and where our gaps are. And this is part of the effort. A lot of it has gone into subsidies and the white paper, but let's not leave out things that happen beyond subsidies, aside from subsidies, that have exactly the same effect. So this is what we're trying to do. We're trying to say, as the Commission looks over to see what are the spillovers from the Chinese economic model into our economies, let's not forget about that one. And let's see how we can treat it. And finally, and maybe most importantly, people in charge of making those kinds of decisions need to be very, very clear about where the problem exists. Once again, and this is why it was important for me to caveat the study as much as I did and spend so much time on that as I did. This doesn't happen in all sectors. This happens in select sectors where you have size, economies of scales, and a protected market. And by the way, not all of those sectors will even be of relevance to the EU. If you saw on the last slide, you had tobacco there, and no one cares about that. Let the Chinese be excellent at tobacco production. That's completely fine. But let's map out where the protected home market advantage is likely to happen, and let's see how it overlaps with our own priorities for autonomy, strategic autonomy, for competitiveness, for industries of the future. Digital, renewable, of course, and critical infrastructure are, to me at least, the 3 main areas we should look into.
Excellent. Thank you. Let's go to some specific sectors. There's a number of questions here asking about specific sectors. And I think it's important to look at specific industries to really get a feel for what the relevance is. I just want to acknowledge one point that was also made in the chat, and that is really important. There's a danger in this whole concept of being misused, as there's always a danger of concepts of being misused in a double morally way of saying China is not allowed to use its home advantage. I think for economists to say the term protected home market advantage is a very, very terrible thing to say. We could, of course, if we are promoting something like an open home market advantage, we need to talk about this. So I think it really comes down to specific industries and the specific instruments that Chinese policy planning uses in specific industries to look at the areas where this advantage that China obviously has is an unfair advantage, and which are the areas where it's absolutely okay for China to use this advantage, because if obviously you have the burden of having to feed 1.3 billion people, you may also have the advantage, of course, of having 1.3 billion customers and a huge intelligent workforce and so on. Let's go to industries. One that has been asked about is the automotive sector, which is one where European companies, at least for now, have been quite successful. How does this fit into your concept, and how retainable is that advantage that European automobile companies have had over the medium and long term?
Before Agatha maybe goes into the automobile, I would like to just add a little point to what you just said, Bernard, and I think that's really important. We're not saying that China cannot do this, but the fact that China does this is something that Europe has to relate to. And it has to acknowledge that it's happening, and it has to find policy responses, no matter whether this is fair or unfair. It really doesn't matter in that instance. It matters that it has an impact on European industry. And I think that's the point that we would like to stress with this, and that's really important as well, that no one wants to say China can't use economies of scale at home. That's not the point. The point is, we need to be aware where it's happening, and we need to find, and we need to be very clear with regard to our own industry as well, especially at this juncture where we find ourselves at the moment, where we're thinking about industrial policy, where we're thinking about future competitiveness. Where exactly do we spend government money on? Where exactly does the taxpayer have to get involved to kind of subsidize or make off some of the advantages, cushion some of this, what is happening? So therefore, I think it's just the clarity about this that's really, really important, that it's not about a moral standard here, but it's about a phenomenon, an economic problem that we're facing that has an enormous effect. I just wanted to make sure that that's really clear and understood. Maybe Agatha, you could say something about the auto industry.
Yes, absolutely. And I think, I mean, your point, Janka, is really important. And we're not trying to say or mean that we should close off. That's actually the first counter argument. We want to find better solutions than closing off, but we still want to be not naive that it has an effect on us. On the auto industry is a complicated one, and it's a really good one to have there, because we don't mean to say that just because you have closed off your market and your market is big, that you'll be able to develop as a leading market players. It happened in a number of sectors, there's no denying that, but in others, you see that European industries, because of their innovativeness, because of their strategy, because of their core advantages in the industry, maybe also because of the type of consumer they're facing, not so much tendering authorities, but actually consumers at the end of the day have an advantage. And it's a really interesting one to highlight. And I want to speak about aviation in a minute as well, but auto features a number of differences. The first one is that you have barriers that are not so much based on kind of procurement preferences. In rail, in solar, in telco, the barriers are mostly tendering authorities in China preferring local players to the tune of, you know, in the solar industry, 100% of the market share is going to Chinese players. In the rail industry, more than 85% going to Chinese players, and in the telco industry, 70% going to the Chinese telco players. In the auto industry, the barriers are a little bit different. They're JV barriers, so you need to have a partner on the market, but at the end of the day, it's your ability, you sell directly to consumers. And when you have the knowledge, the strengths, the innovativeness of European companies, and you're facing end consumers, and you know how to speak to them, and you have a great brand, and you have a great kind of softer capability to your product, then you can actually overcome this protected home market advantage. And we've really seen in auto that Chinese companies haven't been able to do what they did in rail, meaning that they started off with a JV and then kind of kicked off their JV partners out of the market and just took it all for themselves. It's not been possible just because of the resilience and the innovativeness of European car companies. So it's a really, really good example. And it's a justification, then if you think about policy measures, it's a justification to be really careful once again, not to block off everything, and to have early warning mechanisms or a series of very strong concepts to understand that problem, to be saying those a protected market, a vast market, economies of scale actually lead to market shares global or in China that are seemingly excessive. And if you had this kind of pre-thinking and an early warning around that, you could say auto is actually fine and we cannot worry just as much about it. Aviation is another one where it just, Chinese industrial policy just kind of didn't catch. And it's a really interesting one in and of itself.
Although sitting here in Berlin, Agatha, if you say we don't have to worry about the auto industry, that's obviously a problem here for us.
I'm not saying it's
in Paris that looks different, obviously.
Our Chancellery worries about the auto industry much too much.
A lot.
Agatha, one very quick follow-up, because that's a question here. You've mentioned rail a couple of times. So has the EU Commission's decision to block the merger between Siemens and Alstom, was that an error in light of what you are telling us here now?
Oh gosh, that's actually, it's actually a counterpoint again, and it's the core issue of this question that in a perfect world where you wouldn't have CRRC just growing as this huge competitor on the Chinese market, you would want to see just more competition in Europe. And as a matter of fact, I do believe that because CRRC at the moment isn't that present in Europe, that the competition between Siemens and Alstom is still a public good, because we need so much rail, and we will need so much rail in the future with our climate ambitions, that more competition on the market rather than less is actually a public good. Now, we've seen with Alstom and Bombardier merging that scale is nevertheless an issue, and scale is nevertheless a very important factor. And so we are seeing, in any case, industry reorganization, because it is needed, because the pressure is so much, and because the competitiveness of foreign actors, especially CRRC, is going on them. So it's quite complicated, because it's a matter of years, or it's a matter of years for the pressure to actually arrive on the European market. And at the time when the decision was taken, there were good reasons for it. But looking into the future, there is and there was reorganization because it was warranted.
I guess it's fair to say that even in the Commission, there's a lot of doubt now whether that was a wise decision, and whether that decision would be taken in the same way today, or whether it would be taken in the same way in 3 years' time.
And even if it would be taken today in a different way, it doesn't mean that necessarily it was a mistake at the time. I think that's the problematic situation that we're facing at the moment. This is all evolving very, very quickly. And we're seeing some of these. I think if you pull up the solar graph again, how quickly you see the decline and how quickly you see the rise of Chinese players in this sector is just something that European industry has to just grapple with, and European policymaker especially. If you see how quickly the China conversation has moved over the last 2 years, in and of itself, I think the timing issue is a difficult one here.
Janka, let's move to emerging technologies, and especially green tech. The whole economies and business is developing in the whole climate change discussion. That is really at the heart here, because automotive and rail are traditional industries where Europe is traditionally strong. Green tech is something where we saw in solar, we could be strong, but someone else could be strong too. And a lot of these economies are only just developing now. What do we have to look at in these areas?
Yeah, so in these areas, we see exactly what Agatha was just talking about, that this is a lot of public procurement. We have the same phenomenon in the wind industry that we see in the solar industry. We have a large growth in terms of just kind of Chinese big industries, big companies that are now world leading champions in the wind power sector as well. We see a push for hydrogen. So we see all of these sectors where China is just kind of making a big push, making big investments, where state funding is really helpful, where then procurement is really helpful, where prioritization for indigenous players is really helpful. So we have to be very open-eyed about this. We face a particular conundrum, unfortunately, in the renewable sector, is that we would like, for our climate goals, the whole world to just embrace renewable energy technology, and obviously price will be an issue in this case. So we are facing a situation where some of the ambitions that Europe has, also in its development policy, also in its kind of policies at home, of boosting these markets, run into the interest of European industry. And this is something to be squared, and this is not something we can solve with this study. This is just something that policymakers have to be very aware of, that just saying, we want to push European players in these sectors, and we want them to be competitive, means that they will run into China, that they will have to see that problem. And if we want to then say, this is our biggest partner and most important partner for climate change, then that's just simply not true. This sector will be one of fierce competition with China in the future. And we just have to acknowledge that. Also, in and of itself, it could create a race to the top. It could create enormous amount of competition that is not just good for the climate, but also good for consumers, it's good for prices. That could be the case. But we just have to acknowledge that the whole climate conversation has moved out of the happy place of cooperative relations, something good that we can do with China. It is already part of a competitive dynamic.
Let's zoom out again to the really high political level. There's several questions here about that, about the benefits or disbenefits of the comprehensive agreement on investment, and fundamentally the question of how likely you see EU countries actually coming to a consensus of how to deal with these Chinese protective economic policies, because analyzing this, pointing this out is what think tanks do, but ultimately we need political action. How optimistic or pessimistic are you at the moment that we're going to see some real action there? Maybe Agatha, you go first, and then Janka.
Yeah, well, it is a really good question. We actually had a version of this report that talked about KAI as a done deal. And then we kind of had to revert back to some of our wording, given the development of the past 3 weeks, obviously. The way we had mentioned KAI, and we're going to address KAI back in that kind of February 2021 version, was to say KAI helps, and it helps actually for a few sectors that are really crucial. It helps for cloud, it helps for NEV. Now it only helps if it is implemented in full and it is implemented strongly. And so some of our recommendations around that were to say there needs to be close monitoring, there needs to be kind of almost month by month scrutiny about whether the pledges China has made are being upheld. There needs to be a plan B for if the pledges aren't held, and how do we do about that? Is it just public denunciation and criticism? Do we go further? Do we threaten, so to say, to review KAI after a year or two? That's been done with other trade agreements or investment agreements, so that's a possibility. Now that KAI is not as much of a certainty anymore, there are a few ways to think about how to open up China in a more aggressive way, so to say, that we don't have KAI on the table and as the main vector for that. Part of that is the IPI and rediscussing the IPI to try and make sure that at least in those heavily tilted toward procurement, in these sectors heavily tilted towards procurement, that we have a lever and we use a lever to open up more of China's market. And I think that's an interesting way forward, and certainly one that needs to be thought about. The other option, and we saw a little bit of that in KAI, is actually having more ad hoc deals in terms of market opening. I'm not meaning to say we should go Trumpian and have a phase one deal, right? But there's also a value in saying, let's have a discussion that doesn't last 7 years and actually focuses on 3 sectors that we think are really, really the most important for us. And let's discuss opening in those, and let's have very, very clear guidelines for how much, how quick, and how well they need to be open. And let's be a bit transactional. We saw a little bit of that in KAI around renewable energy, precisely with market share mentioned there in the annexes. Let's think about that too. And maybe by thinking a bit outside the box in terms of how we open up the market, the Chinese market more, then we can remain committed to open trade, open investment, and we can actually have our cake and eat it too, right? Just eat a bigger share of the Chinese cake. I'll leave the rest to Janka. We've got a few minutes.
Although I think it would be the fantastic ending to say we'll eat a bigger share of the Chinese cake as a final word to this. But maybe just to point out one last little problem that we're facing. I think what we need to do with this is to make policymakers across Europe particularly freaked out a little bit about the challenge that we're facing, but not too freaked out to not understand that we still can attack this with a lot of confidence, that European industry is still a very, very strong player. So how do you get the balance right between stirring up the conversation enough at the moment that people realize that this is something that's not to be put off for the next 10 years, but something to be focused on right now and right then, and to incorporate in all of the different choices that are just currently being made in kind of restructuring our supply chains and reorganizing with allies and partners, and that's a really key element of this. I think that's the biggest political challenge that we're facing. And so we can only do kind of raise awareness and say this is happening. But what the political level now needs to do is just incorporate that in their thinking and need to understand that particularly the partnership element of this, strategic autonomy, European sovereignty, all good and fine. But what we need right now is broad coalitions that are pragmatic and that are centered around building scale, providing alternatives, and thinking also Asia beyond the Chinese market. And the singular focus on the Chinese market and access to the Chinese market as the kind of savior of industries is probably a thing of the past. And just acknowledging that and understanding that and building something around that that is pragmatic, that doesn't say we don't need China anymore, but that says China plus, we need to have other markets, we need to develop other markets, we need to develop other supply chains, and that will take some time and we will need partners for that. But I think then European industry can be very confident in approaching this and then also competing with China and with Chinese industry on global markets. And that would just be good for global competition and for the kind of rules-based trade that we are looking for.
Thank you very much. We have to wrap up. I apologize that we couldn't go in detail into all the questions that you posed in the Q&A function, but the discussion really doesn't end here. Do take it onto social media, take it to your next discussions and webinars. This whole discussion about the protected home market advantage is going to be here to stay. It's going to be very important in the coming months, and I'm really grateful for the report that Janka and Agatha put out to steer and clear our thinking a bit on this issue and give us on some direction of how to think about this. Thank you very much, Janka and Agatha. Thank you everyone for joining this call. Have a great day and do enjoy reading the report. Thank you.
Thanks everyone. Thanks, Bernard.
Thank you everyone. Bye.